We are required by law to balance the budget of our preliminary budget for this fiscal year and the next one. And we've showcased that in order to do so, what the path that we want to pursue is working with Albany to raise taxes on the wealthiest New Yorkers, the most profitable corporations, by that little bit more, while ending the drain that has characterized the relationship between the city and the state, so that we can balance that budget. If we do not have that state action, then the only tools that the city has at its disposal is a property tax increase. That is not a pursuit that we want to follow through.
New York just raised taxes, and corporate America responded in a way that spoke louder than any press conference ever could. Not through a polished statement, not through a carefully worded shareholder memo. The response showed up in moving trucks lining the streets. This is what can happen when a city known as the financial capital of the world increases pressure on the very earners and companies that helped build that reputation. For decades,
on the city tax, though, and I know that takes effect with people right now, that top rate of people of 50,000 or more. So if you're going to be adding 2% to people at $1 million, that I just did the math, right? Well, but that's going to be an increase of 51% of what they pay now. I'm not saying cry for them. I'm saying if they leave, you're not going to get that money. And when you increase someone's taxes by 51%, aren't a lot of people going to leave?
Manhattan has been the power center of finance. Now, with new tax changes in place, many are watching closely to see how businesses react, and the next phase of this shift is already unfolding in real time. Here's the headline figure. When you combine state and city taxes, New York's top marginal income tax rate now reaches nearly 15% for high earners in Manhattan. That means close to 15 cents of every dollar earned goes to local and state taxes before federal taxes are even calculated.
We're saying we're increasing it by 2% of what it is right now, and ultimately, I'm guided by the facts. The Fiscal Policy Institute did an analysis of the top 1% of New Yorkers and found that they leave the city at 1/4 the rate of other income categories. And when they do leave, they leave to what are called high tax states, New Jersey, California. So what it then comes down to is, why are they leaving? Is it fiscal policy or is it actually quality of life?
In comparison, states like Florida, Texas, and Tennessee have no state income tax at all. The numbers are straightforward, and financial executives pay attention to numbers more than anyone. But this story goes beyond wealthy individuals reviewing their tax bills. The bigger issue is the ripple effect. When major employers reconsider where they operate, it can influence office markets, local services, and everyday workers across the city.
And I've heard that time and again from wealthier New Yorkers, from all New Yorkers.
So it's talk. They're going to go to Florida and all you think is talk.
In 2021, when I came to the State Assembly, we had the same fight to fund public schools, to raise taxes on billionaires and corporations. We were told millionaires would flee.
Yep.
And we now have more millionaires.
Okay, so the New York Times is saying that Mayor Adams is trying to gather business leaders to support him, to say this is going to be bad.
This isn't just about boardrooms and corner offices, it's about how economic decisions at the top can reshape the broader business landscape of New York. When a major financial firm shifts its headquarters from Midtown to Miami, and several already have, it's not just a top executive packing up an office. It often means thousands of roles gradually relocating. It means fewer client lunches at neighborhood restaurants. It means large office leases and premium towers quietly ending. It means a slowdown in the everyday spending that keeps entire business districts active and energized. One company's exit can slowly reshape a whole support network that rarely makes headlines. Vendors lose contracts.
And Bill Ackman, billionaire hedge fund manager, of course you know of him, New Yorker, he said he agrees with you that the city's broken, okay, but he has a real problem with your economic policies. He said the ability for New York City to offer services for the poor and needy, let alone the average New Yorker, is entirely dependent on New York City being a business-friendly environment and a place where wealthy residents are willing to spend 183 days, the amount you need to be taxed, and assume
Nearby dry cleaners see fewer suits coming through the door. Coffee shops feel the drop in morning traffic. Car services notice fewer airport runs. These are the behind-the-scenes layers of the economy that depend on major employers staying put. And when that anchor shifts, the ripple moves fast. What's different now is the tone. Corporate relocations that once happened with little attention, maybe a short note in a trade publication, are now announced with high visibility.
the associated tax burden. Unfortunately, both have already started making arrangements for the exits. So you just think that that isn't going to add up. And by the way, that corporate tax rate that you're talking about, that's a big increase.
That's matching 7.25% going to 11.5%. And the point of it is that if it works for our regional neighbor, why can't it work for us? And with Bill Ackman, this is someone who put $500,000 into Andrew Cuomo's super PAC, someone to whom clearly money is not an issue.
Some states roll out formal welcome events complete with ribbon cuttings and public remarks highlighting their business climate. The message is clear and confident. Opportunity is open for business elsewhere. That public shift says something about changing business sentiment. Executives are not just evaluating numbers quietly, they're signaling their decisions more openly than before. The latest wave followed a state tax package that some analysts describe as more than a routine adjustment.
And ultimately, even for him, life would get better. Because what I'm looking to use this money for is to make the quality of life across the city better.
Okay, he's not alone. There are a lot like him, whether it's Ken Griffin or CEOs of big banks. Would you meet with them?
I'll meet with anyone. I will meet with them and I'll explain why I believe in the necessity of raising the top corporate tax rate. And I'll also tell Bill Ackman that I firmly disagree with his attempt to dismantle diversity, equity, and inclusion across the country, because it's not only against the morals of so many, it's also against the actual bottom line for so many businesses. And as a businessman, he should understand that.
According to public discussion, it sent a broader signal about how future revenue gaps might be addressed. And for companies constantly reviewing costs, long-term predictability matters just as much as the headline rate itself. When policymakers returned to higher earners and major employers for additional revenue, many executives took notice. CEOs, CFOs, and board members reviewed the signal carefully. And some began reassessing their long-term plans. Public records showed that relocation inquiries to corporate attorneys in states like Florida and Texas increased sharply in the weeks following the announcement. Are underway. And once those internal reviews begin, history shows the outcome can shift quickly.
Mayor Mamdani's proposed budget has scared a lot of people. Homeowners, co-op and condo owners, building owners, anyone who could see their property tax bills go up if Albany doesn't find extra money to bail the city out of its fiscal crisis.
I think they would freak out.
Paul is worried too.
Absolutely impinge everything. I mean, I'm raising a 9-year-old kid, and everybody knows when you're raising kids, it's every dollar counts.
Companies often evaluate costs, regulatory climate, and long-term stability all at once. And those conversations can reshape strategy faster than expected. Here's why analysts say this situation carries weight for New York specifically. The city's revenue structure is highly concentrated. A relatively small percentage of high earners and large corporations contribute a significant share of total tax collections. Some studies estimate that the top 1% of earners account for roughly 40% of state income tax revenue. That level of concentration creates sensitivity in the system. When even a small portion of that group adjusts location or income strategy, the fiscal impact can be noticeable. The numbers move quickly in both directions. Increasing rates to address shortfalls can, according to some fiscal observers, create additional pressure for relocation considerations. Analysts have discussed this dynamic for years, and recent activity suggests the debate is moving from theory into visible economic behavior. To be fair, New York officials strongly challenged this narrative. Leaders in City Hall and Albany argued that companies have relocated for decades, and the city has consistently adapted and recovered. They point to powerful advantages: deep professional networks, a massive talent pool, world-class infrastructure, cultural influence, and an unmatched concentration of deal-making activity. Their message is clear. New York offers something difficult to duplicate. Supporters of this view say that while other states may offer lower costs, they cannot replicate the scale and energy of New York's financial ecosystem. The city remains home to the New York Stock Exchange. Major global banks continue to maintain large operations there. Predictions about the decline of Wall Street have surfaced before, and many of those forecasts turned out to be premature. However, some analysts note a key shift in today's environment. The companies reconsidering their footprint are no longer just smaller or lesser-known firms. Recognizable industry names are part of the conversation. At the same time, technology has reshaped how business operates. Remote work systems, digital trading platforms, and cloud-based infrastructure have reduced the need for constant physical proximity in ways that would have seemed unlikely years ago. The long-standing belief that you must be physically present in New York to compete at the highest level is being re-evaluated. Increasingly, companies can operate across multiple locations without sacrificing connectivity. That reality changes how executives calculate costs. Businesses that might have absorbed higher expenses in the past because relocation felt too disruptive are now reviewing the numbers with a different lens. The equation looks different than it did a decade ago, and corporate strategy is adjusting right along with it. New York's policy direction suggests to some executives that tax pressures may continue rather than decline. That broader perception is shaping long-term thinking in boardrooms. This isn't just about one policy change. It's about how decision makers view New York as a long-term base of operations. In the past, a company might have absorbed a tax increase and simply moved forward without revisiting bigger questions. Now, that same increase can act as a trigger, prompting discussions that had been postponed for years. According to professionals who handle corporate relocations, the tone of those inquiries has shifted. What once sounded exploratory now sounds more structured and strategic. Meanwhile, the states attracting these businesses are not standing still. Texas, Florida, Tennessee, and North Carolina have dedicated economic development teams focused on easing transitions. They offer streamlined registration processes, relocation support, and detailed cost comparison breakdowns prepared in advance. In some cases, outreach is direct and highly organized. It's an active competition for corporate presence, and every state involved understands the stakes. At the neighborhood level, the effects can be noticeable. When a major employer reduces or vacates office space in Midtown, the impact extends beyond the building itself. Restaurants experience lighter weekday traffic. Parking facilities see fewer long-term accounts. Residential demand in nearby areas can soften as employees choose to live elsewhere. These shifts happen gradually, but they reshape the rhythm of daily business activity block by block. The conversation isn't just happening in executive suites, it's playing out across the broader commercial landscape of the city. As office demand shifts, property values can adjust and property tax collections may follow. For a city already balancing complex budget priorities, that can create additional strain at a time when resources are tightly managed. This is where corporate decisions connect directly to everyday residents. Someone paying rent in Astoria or commuting from the Bronx may never see a corporate finance spreadsheet, but broader economic adjustments can influence daily life in subtle ways. Public services may operate with tighter funding. Certain city programs may face review. Hiring trends at higher salary levels can slow, and when that happens, the effect can gradually move through other layers of the job market as well. Economic momentum at the top often supports opportunity further down the ladder. So where does that leave residents who aren't executives and don't have the flexibility to relocate? It can leave them watching a city navigate a structural revenue challenge. Historically, governments address gaps through a mix of spending adjustments or changes to how revenue is collected. Neither path is simple and both require careful long-term planning. These are policy discussions that affect everyone, not just corporate leaders. At its core, this conversation is about stability and confidence. Businesses tend to invest where they believe the policy environment is predictable. Long-term commitments, offices, hiring plans, infrastructure partnerships are built on the expectation that conditions will remain relatively steady. When companies evaluate where to expand or maintain operations, consistency often weighs just as heavily as cost, and that broader sense of predictability plays a major role in shaping how cities compete for investment in the years ahead. Confidence in New York's long-term business climate is clearly being tested, and the evidence is visible in the choices companies are making. Some decisions are quiet and procedural, others are public and symbolic, but together they tell a story. Corporate leaders have reacted to the latest tax increase not with dramatic speeches, but with practical steps. Office lease endings, updated headquarters filings, and formal welcome events in states actively courting their investment. This moment now places a strategic question in front of New York's leadership. Can policy adjustments restore confidence and stabilize the trend? Or will the current direction encourage more companies to reconsider their footprint? Early indicators suggest momentum is shifting and relocation activity continues to draw attention. The broader outcome will depend on how both policymakers and business leaders respond in the months ahead.